breaking a value investing rule by buying Grab stocks. I am going to break one of the cardinal rules of value investing, which is to invest in a company that has just gone through its IPO. The company is Grab. In value investing, we are looking for well-developed, financially stable and cheap-to-buy companies. All of well-developedness only comes after the company has spent years and years showing that it can make a profit. Generally, we look at the financials for 10 years, but I am breaking this rule and I am going to analyze Grab. G-R-A-B or Grab, which is the ticker symbol and the name of the company, recently underwent a SPAC and managed to list itself on the Nasdaq. Many US investors would not have even cared, but Asian investors, especially Singapore, would have cared because this is a homegrown company. The reason why I'm analyzing Grab is not only because it is a local company, but also the stock price has tumbled a good 40% from its high. And I'm seriously asking myself, is this a buy opportunity? Upfront, I'm going to be honest and tell you that the financials are shit. And there is no point using formulas valuing the company by looking at its books. Hedge funds and index funds may find some meaning at looking at negative numbers in the annual reports, but not value investors. It's a startup that has just IPO'd. It's not making profit in any sense. So I'm not going to be bothered with valuations per se. The only reason I want to buy Grab stocks is future growth. Chasing that magical unicorn called growth is like getting a money-filled adrenaline jab. Okay, let me explain what I'm thinking, okay? Grab is known to be a taxi company, and that's fine. But it's also a food delivery company. Some sort of enterprise business, has a new initiatives arm, and most eye-catchingly, it is also a financial services company. So the taxi and food delivery company part, many people already know of it. This pandemic, Grab capitalized on hungry mouths stuck at home and grew these two services. But what I'm really interested in is its financial services arm, and that Grab hopes to expand in Asian countries. In fact, you may have seen such ads in train stations in Singapore. But Grab isn't only in Singapore. It's in Vietnam, Indonesia, and other countries as well, and these are massively poised as the next booming economies. So, Grab is properly positioned to take advantage of growth in these countries. Being a financial services company gives it a huge economic moat, and that is why I am interested in Grab. But not all is rosy at Grab. You only need to see who some of the main investors are and worry a little bit if they will back out or not from Grab. According to their 20F filings, the principal shareholders are SVF Investments with 18.7% shares, Uber Tech with 14.3% shares, and DD Shu Sing with 7.5% shares. And Toyota Motor Corp has 6% shares. Toyota and Uber, I think they are in it for the long haul. But I'm a little worried about SVF Investments and DD Shu Sing. SVF is basically SoftBank, and Masayoshi Son is an aggressive investor but also has been known to be fickle-minded, changing his positions about who to support. DD Shu Sing is already in hot soup with the US, and their company is losing some serious investor money. My fear is if either SoftBank or DD Shu Sing makes a sudden and alarming move with their Grab investments by selling their shares, the share price can seriously tank, and the company's credibility can be called into question. Ultimately, it is still in its early years as a public company. So in conclusion, Grab shares have dropped 40% from its high and is trading below its opening IPO price. There is definitely room to grow for Grab because they are in emerging markets, but the major shareholders still control a lot of power, and that can be dangerous for a layman retail investor like me. So yeah, investing in Grab, it's a tough call.